Hey, this is Chris, and in this video I'm going to be talking about what interest rates being cut to 0.1% in Australia means for savers and investors. So very quickly, first of all, on the reason why interest rates have been cut. Now in 2020, Australia entered its first recession in several decades, and the policy response from the Reserve Bank was to cut interest rates to do a few things: to spur growth, to spur new jobs and investment in new jobs, as well as to bring inflation back up to their target band of 2 to 3%. Now, cutting interest rates to 0.1%, which I should mention hasn't just happened in Australia, but in a lot of the developed world, has huge implications for savers and investors. For savers, it obviously means leaving your money in the bank or in term deposits or high interest accounts becomes a lot less appealing. I've seen a lot of high interest accounts now paying well under 2%, which is the lowest ever in Australia. So savers are starting to look elsewhere for alternative investments that can give them a higher return. Investors are the biggest beneficiary because now they're seeing a flow of funds in from savers, as well as the dividends of investments looking more appealing relative to leaving your money in the bank, as well as the future cash flows of the companies listed on the stock market being valued at a higher amount, because the discount rates that are being used to discount those future values into current day values are lower, and therefore people are prepared to pay more for shares now. So if we look around the world at other countries and other places where interest rates have been cut so aggressively to close to zero, there's been a range of things that have happened. So after the financial crisis in the US, where they cut interest rates to close to zero, it had a profoundly positive impact on their share market. In fact, the S&P 500, the broad index in the US, went up by over 200% over the decade that followed, largely because of this interest rate policy and what it meant and what it led to in their economy. But it's not always the case. In Japan in the 1990s, where they also had to cut interest rates, it didn't have a positive impact on the share market because it didn't drive growth, it didn't drive new jobs, and it led to a lot of people hoarding cash, which led to deflation in their economy. And actually, share markets didn't do very well for the next decade, but bond markets did really well. So what can you take from interest rates falling to zero? Well, generally, it should have a positive impact on the share market, but if people in the economy behave in a different way, it may not. And that's why my view is that you still want a balanced holding of different investments in your portfolio. It still makes sense to own assets like gold and bonds. Even though they don't generate a lot of income, they're safe, sensible investments that will benefit if people start to hoard cash. On the other hand, you also want to have shares in your portfolio for the potential benefits. I'd love to hear what you think about low interest rates and what it means for your portfolio and your investment strategy generally. And if you like videos like this, please hit the subscribe button as well.